Hello everyone, welcome to this week's market analysis. My name is Carl Cavalingua and it is a pleasure to be with you as we delve into what went right, what went wrong on markets last week and have a look to the week ahead. Well, let's kick off with what went wrong on markets, and you kind of have to start at crypto. Look at those falls for the week. Avalanche down 41%, Solana down 35.6%, and whilst they aren't quite as bad from there, they're still pretty terrible. The majors, Bitcoin down nearly 17%, and Ethereum down about 23%. Now, I took this snapshot sometime Sunday sort of morning, so some of these might have changed since then. We have seen a little bit of a rally this Monday morning, but it doesn't change the fact that for the week, crypto has been absolutely belted, and for the month, you can see even steeper falls, and really just Solana now showing any gain for the last 12 months. Having a look at the Fear and Greed Index supplied to us by alternative.me at 10. Now that is a little bit up from yesterday, of course, but way down from last week and way down from last month. So why such negativity in crypto markets? Well, it can be explained by what happened on this chart and the next. This is TerraUSD. Now, in theory, it's supposed to be a stable coin, and as the name suggests, therefore pegged to $1. As we can see during the week, sort of around about late Tuesday, Wednesday, that peg started to come undone. And once it started to come undone, it completely unraveled the price of Terra, now trading at around about 12 cents in the US dollar. So completely not supposed to happen. Now, there is a crypto bank sort of backing this arrangement here of the peg to one that in theory is supposed to be there to maintain that peg or really collateralize this concept. Money started to come out of that crypto bank during the week. I haven't been able to find any explanation why the money started to come out, but as it started to come out, it continued to come out. And therefore, there was a bit of a run on the stablecoin. Now, unfortunately for holders of this cryptocurrency, Luna, there is an algorithmic arbitrage arrangement between the stablecoin and Luna, whereby if the stablecoin is trading below one, you're able to mint Luna. So obviously, that means minting of a great deal of Luna and devaluation of this cryptocurrency as well. And really, Luna only has value if the peg on TerraUSD is holding around one. We can see as that peg unraveled, so too did the price of Terra. Now, the upshot of all of this, we've seen about $18 billion of investors' money wiped out of the stablecoin, and from the highs here around about 120, about $44 billion of investors' money wiped out on Luna, which, as you can see now, is trading at 0.0002256. So we are looking, if this is 1 cent, this is 1/10 of a cent, and this is 2/100ths of a cent. So for all intents and purposes, you could argue that that one has gone to zero, and it has actually been delisted from a number of the major exchanges. Now, obviously, this doesn't bode well for the broader cryptocurrency universe. It does sap confidence out of existing crypto investors, and of course, it's not a great advertisement for those institutions looking to get involved. The other downside, I guess, for Bitcoin more specifically, was that the company that controls that TerraUSD and Luna structure did have a significant holding of Bitcoin, and that through this phase here where they were buying actually supported the Bitcoin price. Unfortunately, as that peak came undone, they did have to sell or liquidate their holdings of Bitcoin and other key cryptocurrencies to try and defend that peg. Of course, they were unsuccessful in those attempts, but the liquidation of their holdings certainly caused Bitcoin prices to fall sharply into Thursday morning's low there at 25,365, taking out about half a dozen key support points here in that sort of 28.5 to 30 range. Look, the damage was largely recouped or mitigated by the close of that candle. We have seen some recovery over the weekend, which is encouraging. The other thing I'd like to point out here, obviously, is that anytime you see a large lower shadow like that, it tends to be quite bullish. And when it's accompanied by large volume, it's even more bullish, because what it's telling us, remember, volume is buying and selling. We have seen a lot of selling. We know why the selling was there. It was, forced liquidations, but somebody needs to buy that stock. So we did see a soaking up of that massive supply, and once that supply had diminished or been taken out of the market, really all that was left over was demand. So that's actually a pretty encouraging signal there for Bitcoin to potentially continue to rally Unfortunately, though, it's going to start to come up against some pretty key resistance levels in the not too distant future. So around this short-term dynamic trend zone here, we're about 34 to 34.5, probably going to see some supply. We've also got some key static levels here, 32,992, 34,329, probably going to impede price action to the upside as well. Not the end of the world. Look, we're going to get some pretty clear signals on Bitcoin, I think, very soon as to what we need to do. So if we see that supply come in, it's going to manifest itself as some pretty nasty black candles in here or some upper shadows. That would indicate that, look, the short-term party's probably over and we're going to resume this long-term downtrend. However, if we don't see those, in fact, if we see a bunch of white candles, a bunch of lower shadows, it would tell us that the market's not too fussed by these potential supply zones. In fact, we're seeing accumulation in the system, and we actually could turn that short-term trend and go higher, but hey, we're probably getting a little bit too far down the track. Having a quick look at Ethereum, I'm not going to spend too long on this one, probably can just say ditto. It was caught up in, I think, those forced liquidations. We have seen a pretty decent rally on some volume from there, but we are probably going to impact, I think, those static supply zones earlier than Bitcoin potentially, and still have some issues here around about that 2400, 2500 zone. Again, watching closely for the candles in there for clues as to where we might be going next. Bringing it back home, at least if you are here in Australia with me, to equities, we can see a pretty tough week on Australian equities, falls almost across the board there. And a lot of it was to do with that crypto and just the negativity in markets in general, where falls in crypto led people to be nervous on stocks, which caused falls in stocks, which then caused falls in cryptos in many ways. I think last week some of that fear tended to feed on itself. S&P ASX 200 down just under 2% for the week. Worst performing sector, no doubt about it, is gold. That gold price continued to fall during the week despite all of that fear, and that is contrary to what most gold bugs would preach to you, that gold is a bit of a hedge in times of uncertainty. So because that relationship really didn't hold, I think a few positions there on gold were liquidated and also in gold stocks. Having a look at the next worst, that would be technology. NASDAQ suffering some sharp falls during the week, but there is some light at the end of the tunnel, and that we'll discuss in a second. And the strongest performing sector, no doubt about it, was healthcare. In fact, the only sector in the green, as we saw a pretty decent rally in CSL shares, up around about 3% for the week. And that chart is actually looking pretty good. Make sure you go check that one out after this session. Volatility on the rise. Looking at the chart here for the ASX 200, we can see a pretty decent rally on Friday. And that has anticipated some very sharp gains in US markets on their Friday session. So today we might not see a huge follow through in that fledgling rally, largely because we've already anticipated it. We may see a pretty flat day, in fact. However, if we can manufacture another really strong gain, that would speak volumes as to the positivity in the system. In fact, that we're actually anticipating further gains in the US. If we had a big wipeout down day, that would be extremely bearish. We don't want to crack below 69.59 again. I mean, we did it on Thursday, and I would have said at that point that things are looking pretty terrible. Friday's gain does change things somewhat. So let's assume now we've had a hold, a test and a hold of this key support zone that we did identify last week, to be fair. And the next key pressure point now will probably be 72.33. Expecting a fair bit of supply in this level from the dynamic trend zone, so we can see the long-term and the short-term trend zone now coalescing, and potentially even from that static supply point there at 72.33. A little bit like Bitcoin, if we get into this zone with a bunch of black candles, it would be bearish. It would be indicating that we are very much in this sell the rally phase, and probably in the very early stages of a new bear market, potentially even. If we hit there with a bunch of white candles, a bunch of lower shadows, hey, it's actually telling us that markets aren't afraid of that level. In fact, probably gearing up to go higher. So good news is, whilst there's some uncertainty out there in the technicals at least, we're actually getting close to some pretty key levels, which could give us a very strong indication one way or the other. If we do happen to break below 69.59, then I'd be watching very closely for demand to kick back in at 67.58. Having a look across the region now, Nikkei down 2%, Shanghai Composite rallying. They did have an abbreviated trading week, so I'm not sure how much you can read into that. Hang Seng probably is more accurate there, down 4.3%. US markets, as we can see, suffering during the week also, but to be fair, halving their losses for the week. Yes, halving their losses for the week in that Friday session. NASDAQ still closed down about 3.8%. European markets escaped most of the carnage, but to be fair, most of that is coming towards the end of the week. We're still seeing falls overall for the month. Volatility edged down very, very slightly, but it's still trading, to be fair, at elevated levels compared to sort of post-COVID. Having a look at some of the key charts there from the US, S&P 500, nice little bounce here on Friday. Key levels, these three red arrows here, 40.62, 41.14, 41.57. Again, watching very closely for either black or white candles in there. Black would indicate a continuation of this developing downtrend, going to suggest, for all intents and purposes, if we see that, I will officially call a bear market in US equities. If we see white candles in there, well, actually, we could be starting one of those V-shaped rallies. Having a look at the NASDAQ, as you can see, this one has suffered far more than the S&P 500, and I have called this one many times as a bear market. Key levels here, probably that handle there at 12.074, which was that support point we were watching out for. That broke during the week. Then 12.985 is probably the more appropriate level to be looking at a balance point between the current bear market and a potential bullish recovery. Looking at industrial metals now, again, when markets go risk off, these tend to suffer. There's a little bit of a typo on screen. I didn't fix it. I'm sorry. That should be about minus 6.2% there in China. It reflects obviously the fall in Singapore there at minus 5.4%. Precious metals also lower for the week. Having a quick look at the iron ore chart, because it is so important for our local market with the likes of BHP, Rio, Fortescue having pretty big weightings in our ASX 200 index. It has appeared to have turned the corner and really is starting to look like more and more a long-term downtrend. Let's give it a tiny benefit of the doubt and say that if we can very quickly get above even that 140 zone, that view might change. But until then, I think you still have to be thinking about sell the rally and therefore be really cautious about some of your resources, stocks, holdings. That view, I think, is reinforced by this chart here with a clear breakdown of that long-term uptrend in copper. And what we're watching for now, we've talked about this a few times in this session, this idea of, well, a breakdown or a move lower is something, but it's where we go from here that kind of matters the most. And if we start to fail at some of these, what should act as now resistance levels, that long-term previously support zone, right now potentially acting as a supply zone, we will then be in sell the rally and potentially at the start of a far deeper correction in copper. So a little bit concerned about that one. Nickel, not as concerned about this. We have talked for a few weeks now about the likelihood of this coming back and testing that long-term trend zone simply because this was such an aberration. So probably all to plan there on nickel. Not all to plan here on gold. This was supposed to be gold's bull market. All of this fear and uncertainty around, it just hasn't been the case. In fact, it has pretty much unraveled over the last couple of weeks and therefore just completely undermined the sentiment in that market. So the trend there, well established to the downside in the short term, long-term trend pretty much breaking here. And I don't think you need to be looking for longs in that market anytime soon. However, potentially looking for longs in this market here. This is the West Texas crude oil chart. And you see it's actually shaping up really nicely here through this consolidation phase, but sort of moving more and more towards the top end of that phase. We saw there's sort of a bit of a false test there at 109, a little bit of a false break there at 100, but I think a close above 111.40 would start to really convince people that we're moving back into this long-term uptrend after that sort of consolidation phase. Plenty of demand points through here anyway, and probably fewer supply points to contend with. Apart from that, currencies generally down as the US dollar continued to power higher. Something we haven't seen for a while, though, is some red in these two boxes here. You can see how green they are for the month and for the year. And what we're talking about, of course, are falls now in interest rates during the week. So we saw the Australian yield pull back from about 3.6% into about 3.4%. Doesn't sound like much considering that it was only 1% about 7 or 8 months ago, but I think we'll take it at this stage. So Reserve Bank cash rate still expected to be about 2.75% by Christmas. That's extraordinary. Probably can't see it getting there. I think this has overshot to the upside. If it does come down, it does provide some relief for the share market. We could get a little bit of a bid side tone back to it. But don't forget what we're seeing here as yields fall, obviously bonds are rallying. So bonds are getting a bid. It means some of that money that's been in cash through this phase moving back into bonds, and the next step potentially is that some of that money moving back into stocks. Having a look now at some of the economic data from the week, starting with the NAB business confidence over here in Australia. Confidence slipped 6 points seasonally adjusted. You can see the trend, which takes into the last few months, is still heading higher. Conditions, however, continued their recovery. Profitability improved, employment was flat, and we can see that it's the reopening sectors that did the best. So recreation, personal services, so going out and getting a haircut were the strongest, but we did see improvement pretty much across the board, as can be seen in this graphic down here, with mining certainly still booming. Cost pressures did weigh, however, and that is undoubtedly the reason why confidence was so negatively impacted. Labour costs up 3%, purchases of inputs up 4.6%, and we can see here that most businesses weren't able to completely pass on those higher input costs, with only a 1.7% increase in their output prices and only a 2% increase in their retail prices. Having a look now at consumer sentiment locally here in Australia, it was the lowest read since September 2020. Floods, inflation, interest rates continue to dominate the minds of consumers. Confidence among those with a mortgage fell by 9.2%. This is the first survey reflecting the liftoff in RBA official rates. Contrasting that, of course, if you are lucky enough to have some cash in the bank and therefore take advantage of higher interest rates, you tended to be more confident. We can see gains for those over 65, plus 7%, and homeowners, those who own their home outright, plus 5.5%. Time to buy a major household item, that's very interesting, down 5.3%. The index is now 22% below its long-term average and has fallen nearly 11% in the last 6 months. This is important because it's reflecting a big change in the way we are consuming. We're going from buying goods and stuffing them in our houses, potentially, to consuming more services. This should alleviate some of that goods-based inflation that has been coming through the CPI and also help ease supply chains. Finances compared to a year ago, that's a little typo there, should be minus 4.8%, which was the most significant weakening in the index. Heading over to the US now, we had some key inflation data during the week. Inflation is on the rise, but not why you'd expect. Headline inflation for April plus 0.3% versus a 0.6% gain in the core. And it's pretty unusual to see the core go up more than the headline. Headline, however, still rising faster than the core over the last 12 months, 8.3% versus 6.2% as of April. Now, why did that core rise faster than the headline? This is because gas prices get stripped out of the core, and gas prices actually fell during the month of April. So that helped the headline come down, but did not help the core at all. In fact, the core continued to suffer from rising costs in everything else, particularly services side inflation. Things like hotels up 1.7%. Now that's a 19.7% annual increase. Airfares up 18.6% just in April for a 33% gain annually. We are shifting our consumption patterns from goods to services. Goods inflation moderating, services inflation literally taking off, but food prices are still on the rise and they are still stripped out of that core. And the month of May might not be so good because gas prices are on the rise again. Interestingly, long-term rates did ease during the week despite these higher readings. That's encouraging, and also some higher readings on the wholesale inflation numbers. Double-digit inflation rates at a wholesale level on the headline and a more modest 6.9% on the core. Again, easing gas prices helped, but food-based inputs continued to nag away. President Biden, during the week, told Americans that inflation, or getting it under control, is very much a priority of his, potentially even putting on the table the scrapping of Trump's controversial China tariffs, hoping to reduce some of that imported inflation out of China. Having a look at the consumer sentiment reading now, we can see that was the worst reading since 2011. Inflation continues to undermine consumer confidence, as consumers are expecting as much as a 5.4% increase in prices over the next 12 months. Now that is a 40-year high for inflation expectations. Consumer spending is approximately 2/3 of GDP, so this data and this trend is important. Certainly reduces the possibility of the Fed doing this thing here, which is a soft landing. I'd say chances of that are slim to nothing. Now, US Federal Reserve Chairman Jerome Powell had some comments with respect to the concept of a soft landing. He said it will be challenging. It won't be easy. No one here thinks that it will be easy. Nonetheless, we think there are pathways for us to get there. I think the one thing we really cannot do is fail to restore price stability, though. So you can see he's prioritizing getting inflation under control over potentially limiting damage to the economy via what he would argue is absolutely necessary interest rate increases. A little bit concerning. Let's bring it back closer to home now and look at some of the valuation metrics for the Australian market. We can see it's roughly fairly valued there at 14.9 as of Friday's close. Energy still looking very cheap at 7.9 for its 1 year forward PE. Certainly way cheaper than its 3-year average prior to COVID and way off its post-COVID peak. Material sector also looking pretty well valued there. Maybe that will protect it against potential weaker commodity prices going forward. We discussed that earlier. Property trusts looking pretty cheap as well against their long run averages, and then maybe healthcare not looking as expensive as some of the others. Technology still well above its long-term averages, however, has less than halved, to be fair, from its long-term peak. Having a look at some of the technical analysis factors now, we can see that around 2/3 of Australian companies are trading beneath their 1 year price trends. And that is pretty disturbing, because what we'd like to see in a bull market, a healthy bull market, is around 2/3 of them trading above that trend. We've got the opposite of that right now. In the shorter term, the number of stocks trading above their short-term trends actually decreases to the point where, looking over the last couple of weeks anyway, about 4 out of 5 stocks are in short-term downtrends. Not what we want to see, however. Friday's rally did give us a little bit of improvement there, but unfortunately I think the trend is still to the downside here. So keeping an eye on that very closely. Also keeping an eye on the sector trends. We talked earlier about the short-term downtrend in the Aussie market and potentially that the long-term trend could be changing. Still going with neutral on that. Discretionary down, that hasn't changed. Still a very bearish looking chart on that index. Energy starting to lose a bit of momentum, short-term trend back to neutral. Hopefully those stronger energy commodity prices might help out there. Financials, that trend also easing to neutral in the short term, long-term trend still up. Gold down, tough week for gold. Healthcare, CSL helping that to a short-term uptrend. Starting to look quite interesting now, that sector index. Otherwise, we're down clearly on information technology despite that late week bounce. Materials down now in the short term. That's a little disturbing. We're starting to see that long-term trend moderate as well, potentially at risk of going to down. So some caution, I think, required there. Property trust down, not looking great at all. Staples losing a bit of their upside momentum in the short term, but otherwise long-term trend I think is still intact. Telecoms down, not looking very strong. They do tend to get caught up with the sentiment towards technology stocks, and utilities by far and away this standout sector index there, with both short-term and long-term trends maintained to the upside. And I've talked many times about stocks like AGL, APA and Origin, which are still pretty good on their respective charts. Having a look at the week ahead, look, pretty much the employment data is going to dominate there. That's coming out on Thursday, and we will have our federal election on Saturday. Very interesting to see how trading kicks off Monday following, depending on who gets in. Having a look abroad, we do have our quote-unquote Chinese data dump, which comes out once a month. That should be coming out today. Then we've got some core retail sales in the US, some housing data, but I think the key will be Jerome Powell's speech here on Wednesday, and then a pretty quiet end to the week. Don't forget, each Tuesday I run a free session where you can join me live and ask me questions about your portfolio. Could be stocks, could be crypto, could be indices, could be commodities, anything you like, for 1 hour. Make sure you head to that address there and register. Don't forget, ThinkMarkets has a fantastic offering for Australian share traders. Hey, we also offer CFDs and FX as well, with market-leading platforms, market-leading service, and of course, my analysis. If you're watching me on YouTube or any of the other socials, make sure you hit the subscribe button or the bell icon to stay notified. Please also smash that like button. Well, that's it for me today. All the best for your trading investing. Until we catch up again, bye-bye for now.